Okay, topic 8. This chapter is called Risk and Return. Okay, so far in the course, we covered the math first, the time value of money, and the different types of cash flows. And in topics 5, 6, and 7, we talked about bonds, equity, and investment decision rules. And we were basically looking at everything from the corporation's perspective. Okay. In this chapter, we're going to look at things from the investor's perspective. Okay. So if you recall, in the equities chapter, I clarified some of the terminology. I said the RD um, can be described as the cost of debt if we look at this from the corporation's perspective. But if you look at it from the investor's perspective, then it's their return on debt, return on bonds, return on debt instrument, debt security, however you want to call it. It's the return, and from the corporation's perspective, it's their cost. Okay, same thing with RE. It can be described as the cost of equity financing from the firm's perspective, but from the investor's perspective, who's providing this capital, it's their return on the equity investment, return on equity. Okay, so we're describing the same thing, the rates at which these transactions take place. Again, we had the corporation, we had the cycle of money slide, right? So they're providing capital, in return they're getting something. So these rates can be described as these things depending on how you look at it. Okay, so we're looking at everything from the investor's perspective in this topic. So a lot of you will probably find this topic more relevant, more intuitive, more useful. Okay, so risk and return. Risk, as we've been talking about, just refers to the volatility or uncertainty of future cash flows. The more volatile it is, the more risky it is. Okay, so in finance, we also talk about the possibility of making a loss on an investment. Yeah, but we're not gonna talk about this in detail in this course. Okay, so we'll just say the volatility, uncertainty. Okay, return is pretty simple. It's a measure of the amount of gain made on an investment. So we did a lot of return calculations, right? If you put in $100 into something and you end up with $110, then you've made a $10 gain with your $100 investment. So the return would be 10%, right? That's pretty straightforward. And we've been mentioning that rational investors are risk averse. This was the fundamental assumption in finance. So we don't like risk. Less risk is preferred. Okay, no one likes risk. Lastly, people in the world, they often say, "Oh, greater risk means greater return." Okay, so you see a lot of people saying that, and especially on YouTube these days, you gotta take a lot of risk. That's somewhat correct. To be precise, since we've been talking about finance, we want to say greater risk, greater expected return. Okay, because the realized return, or this would be the actual return, is different than the expected return. Okay, so expected return is different compared to the actual realized return. Okay, yeah, this just denotes the uncertainty associated with these risky securities. Okay, so for example, if you recall, in the second exam, we had a question about the bonds article, right? It's a good time to buy bonds. So bonds, in that article, we saw that short-term investors, short-term bondholders had been losing money for the past 3 years as of 2023, right? So even though bonds are safer compared to equity, we mentioned that in the second exam too, right? Bondholders face less risk. Their bonds are still risky investments, okay? That's why it could be the case that you lose money even though the volatility is smaller, okay? And this expectation just captures that uncertainty. So the return, even though the expected returns are positive usually, you could still lose money or you could gain a bit more. Okay, so we're going to talk about the distribution of returns today. Okay. Yeah, so we're going to calculate expected returns, and we're going to skip risk calculations this summer. Okay, we're only going to do the expected return calculations. Okay, so we're just taking the weighted average of possible returns, and the formula, even though this looks confusing, it's nothing. Okay, you already know this. We're just doing the weighted average calculation. Okay, so to give you an example, at the very beginning of this summer, I think it was in the first video we did the coin flip example, right? When I talked about the risk aversion of rational investors, there only two things could happen. Okay, the possible outcomes could only be one, heads. If you flip a coin, it could land heads or tails. Okay, so only two possible outcomes. Coin probably doesn't land sideways, maybe, but we're gonna ignore that possibility. Okay, and with these outcomes, there are probabilities associated with these outcomes. That is, it's 50%. There's a 50% chance that the outcome will be heads. 50% chance it's tails. Okay, so these are the probabilities associated with these outcomes. Okay, and we said the payoff of the game was, I forgot exactly, but let's say if it lands heads, you get $100. If it tails, you get 0, right? Then the expected return is just the 50% times this plus 50% times this. So to be precise, this would be the expected payoff. I'm just trying to be precise here. Not expected return yet, because we haven't considered the cost of playing this game yet, right? But the concept is similar. Okay, so it's not an expected return yet, but expected payoff of the game is 50% times 100 plus 50% times 0, which is just $50, right? So here I'm just showing you that we're just doing the weighted average. The probability times the outcome, probability times the outcome. Okay, so if we had a return example, we can say the probability of the coin flip remains the same. Return, maybe this is 100% return, 0% return, then the expected return will be 50%. Okay, so yeah, first we're gonna use this formula, so this concept, to do example 1. Yeah, and the solution is already posted. Okay, so we have the probability times the return plus probability times the return plus probability times return plus probability times return. Okay, that's the expected return. Okay, it's just that instead of having a coin flip of 50% and 50%, we have 4 possible scenarios in this case. Okay? Yeah. But as you can imagine, in real life, things are way more complicated. Okay? So we're going to talk about the normal curve, and then we're going to try to characterize the expected returns using the normal curve. Okay? So in the stock market, let me just clear this. In the stock market, let's say this is stock price, maybe S&P 500, the largest 500 companies in the US, and this is time. So if you look at the graph, actually we can look it up real quick. SPY. So this is the S&P 500 ETF. Basically, it tracks the performance of the 500 largest companies in the US. We'll go to max. So if you look, we have data starting back in 1993 up until now, and you see it's in an upward trend. That's the US stock market. It's as you can see from the graph, some people say there's a bubble, it might crash, who knows, okay? But what I'm trying to show you is that the stock market is really volatile. It goes up and down, goes up and down, right? And the stock price is determined by so many different factors. Macroeconomic factors, political factors, I don't know, geopolitical, bunch of other things. Okay? So what am I trying to say? Yeah, so we can't say, for example, let's say we're right here and we're trying to see what will happen to the stock price in the future, okay? Let's say at this point in time, we're trying to look into the future and trying to see what will happen to the future stock price. It could possibly go from here to here, everything in between, right? Or yeah, you know what I'm saying, right? So what I'm trying to say is that we can't just simplify everything into 4 different possibilities, or as in the coin flip example, we only had 2 possibilities, right? But a lot of different things can happen. Maybe right now is 2026, next year is this. It could be, I'm just telling you some weird guesses. Let's say one possibility is AI like solves all human problems, okay? Maybe in that case the stock price could skyrocket because things are so good and everything's so profitable. World is just a better place, okay? Second possibility, another extreme scenario, is that World War III could break out. Possibility, you see a lot of wars happening recently, right? Maybe, I don't know, maybe China invades Taiwan, or I don't know if that's the right term, but everyone starts fighting, okay? And North Korea attacks South Korea, and a bunch of wars start happening, okay? In which case, maybe this will happen. There could be another pandemic, or it could be just a boring as is type of scenario, okay? Just go sideways. Anything could happen, right? So what I'm trying to tell you is that there are basically almost infinite possibilities. Many different combinations of things could happen, right? So these simple scenarios don't really work in real life, okay? We could try, but it's not realistic. That's where this normal distribution comes in, okay? So if you took a statistics course, you did, and you probably have seen normal distributions, but I'll just do a quick review, okay? So we have this normal distribution. So usually this chart is missing the y-axis, but on the y-axis we have probability. Okay. On the x-axis we have some measure. Okay. In this course, or at least in this chapter, we're interested in the returns. Stock, let's say stock return in 1 year. Okay. So going back to this example, we're focusing on this time period. Oh, what will happen from here to here? Will the return be positive 300%? Will it be negative 70%? It will be 10%, negative 10%? What will that be? Okay, that's what we're trying to characterize. Okay, so the normal curve describes the possible outcomes and the associated probabilities. Okay, so down here at the upper end of the tail, let's say right here is world peace slash AI solves everything. So possible, but probably highly unlikely, especially in 1 year, right? That's why the return is very big, large, I don't know what the right term is, let's say 300% return, but the likelihood of that happening is very, very low. Okay, maybe less than 0.01%. Okay. Also, another pandemic happening and ruining everything, or a world war where the stock price drops by like 80%, is also possible but highly unlikely. Okay, that probability also is also very, very low. So something boring happening, maybe the wars start de-escalating, things stabilize a little bit, but then there are some issues, that's more likely, right? In which case the stock market could go up, maybe, I don't, even 20% is a lot, and 20% drop is a lot too, but this area is more likely than the extreme scenarios. Okay, that's why the probabilities associated with these possibilities are higher. Okay, so that's how you read this normal distribution curve. Okay, you want to understand the curves. Okay, so yeah, that's what we have here. So what we have here in this on this slide is actually what's called a standard normal curve with the mean of 0. Mean is where the distribution is centered. Here the mean would be, historically equity returns are like 7%, maybe 7 to 8. Standard deviation measures how wide the distribution is, how wide the distribution is. Okay, so if it's something really volatile, okay, the curve is wider and more flat. But if it's less volatile, oops, what is this? It'll look more like this, less volatile, but more centered around the mean, and it's higher. The probabilities are higher. Okay, you know what I mean? Yeah. Yeah. What else? Oh yeah. And normal distributions are symmetric around the mean. Okay, let me just write these down. The characteristics. First, it's symmetric around the mean, meaning if we were to fold this curve in half, they would completely overlap. And another way of saying this is the probability of observing an observation to the right of the mean is 50%, because we're trying to account for 100% of the possibilities, 100% of the outcome. Probability that you observe an outcome to the left of the mean is also 50%. So they're symmetric and they add up to 100%. That's the key. 50% each on each side, okay, and centered around the mean. Okay. Again, the standard deviation is how wide the distribution is. Variance is also a measure of how wide the distribution is. Variance is standard deviation, right? I'm getting confused. But standard deviation squared is the variance, if I'm not mistaken. Okay, but the variance you don't have to know. Okay, and the things that you do have to know for the exam, you'll see on the next problem, are these things. Within one standard deviation from the mean, you can expect to find 68% of the observations. Okay, that is from here to here. So from here to here, you can expect to find 68% of the observations. That's why from the mean to the first standard deviation, we can expect to find 34%. And from here to here, also 34%. And this one you want to know too. Within 2 standard deviations above the mean, or away from the mean, you expect to find 95% of the observations. So these numbers, these precise numbers, are a little different depending on what source you look at, but still close enough. Okay, 95% will be from here, -2 to -1. That's why 95 divided by 2 is 47.5 from -2 to the mean. Okay, and you see that 34 and 13.5 also add up to 47.5. Okay, so yeah, you'll need these numbers, as you'll see on in the next problem. So mean is denoted as the mu. I don't know why. And standard deviation is sigma. Okay, so mu plus 1 standard deviation and mu minus 1 standard deviation. That is mu plus 1 standard deviation, mu minus 1 standard deviation. Within that area, you have 68% of the observations. And within 2 standard deviations from the mean, you expect to find 95%. And you don't have to know the third standard deviation. Okay? So understand the characteristics of a normal distribution. And again, we're just doing the same thing. We did the coin flip example, right? We're just increasing the possible scenarios into a bunch of other scenarios, like 2 million or plus, okay, possibilities. Then the associated probabilities are really, really small. That's why we use these areas to represent from here to here, how likely is it? You know what I'm saying, okay? Example 2, already posted. So example 2, as you've seen in the previous exams, all the in-class problems we do are on the exam, and this one is there for sure too. This one you either know how to do or you don't, and it's really easy to figure out if you spend some time and try to understand. Okay. Let's see. Okay. Oops. Yeah, let's do this. We have the expected return of a portfolio. Okay. So far, we've talked about individual securities. Now we're looking at a portfolio. Portfolio is simple. It's just a collection of investments. Okay. So so far we talked about the expected return on stock I. Okay. For example, if you invested in Apple, what is the expected return? That was what we did. But here we're getting into portfolios. That is, if you hold Apple and Tesla and GE, or it could just be 2 stocks, now you have a portfolio. Okay, it's a collection of stocks, bonds, real estate, cash, cryptocurrency, whatever. Okay, just collection of different securities. Okay, so here we first want to so we're trying to calculate the expected return of a portfolio. So this is what we're trying to go calculate. To do that, we have to first get the portfolio weights. Okay, so it's just another formula how we express things, but it's real easy. So let's say you have $1,000 and you decide to put in $800, 800 in Apple and 200 in Tesla. Okay, so the weight, I'll just use this notation. The weight in Apple is 80%, right? 1,000 over 800, or 0.8, 80%. Weight in Tesla is 20%. So that's all we're doing here. Total value of a portfolio, and then how much you put in that particular stock, I. Okay. And we know we just did the expected return calculations following this formula, right? So we're gonna do the same thing. So the expected return on your portfolio is just the weighted average. How much is in Apple and the return you made in Apple. How much is in Tesla times the return you made in Tesla, and then we add everything up. Okay. Here we're doing expected returns, but whatever, right? Same concept. Okay. So using that, we'll do example 3 and example 4. Okay. Okay, let's see. Okay, do a little bit more. Oops. Okay. So far, we basically looked at everything from a theoretical perspective. In academia, we make a distinction between theory versus empirics. Theory is based on assumptions and reasoning. So we assume that people are risk averse, and we've already established that stocks are more risky compared to bonds. So the conclusion is the expected return on stocks should be greater than the expected return on bonds. Okay, return on equity or stocks. Okay, so that was something like a theory based on this assumption, and based on the fact that stockholders face more risk, it's reasonable to assume that shareholders should get a higher return compared to bondholders. How things should be based on this rationale. Okay, empirics is saying, oh, that's really cool. Okay, but let's see what happens in real life. Let's see what happens in reality. Okay, and then we're just gonna document what happens in reality, empirical evidence. Okay, so this slide is basically showing you the empirical evidence, what actually happened. Okay, so this is from another textbook. We have, let's see, right here. So actual returns for these securities during this 50-year period. Okay, we have the returns, standard deviations, and variances. We're just going to focus on returns and standard deviations. So return and risk of investment choices. Okay, so here we have bonds and stocks. So as we go from left to right, we have increasing risk. Okay, so left to right, risk increases. Okay, so first, if we just compare bonds, we have, we'll just say they're both US government bonds. It's not clear from the title, but I'm pretty sure. The only difference here is the maturity of the bonds, right? We have a 3-month bond in this column, and long term usually is 10 years or more. Okay, so we have 3 month versus 10 years. So this illustrates the maturity risk premium that we talked about, right? The difference between these columns should describe the maturity risk premium in theory. Let's see what happened. So the average returns, if you look, the longer term bonds have a greater return compared to shorter term bonds on average, okay, using all the data for these 50 years. So that's consistent with theory. Let's look at standard deviation. The volatility was higher for the 10-year bond, which is also consistent with theory. Okay, so let's ignore these number of negative returns and positive returns for now. Okay, so we want to look at the this is the actual return, this column, and the volatility or risk in this row. Sorry. Okay, so we have these numbers, and we also have stocks on the right hand side, the last two columns. As you can see, the returns were much larger for stocks, 14 and 17 compared to like 5%. That's also consistent with theory. Expected return should have been greater, so the actual return was greater, okay? And the volatility also consistent with theory. More risky, more volatile, but on average, they yielded a greater rate of return, okay? So another interesting point here is we have a large company stock versus a small company stocks. These are portfolios, okay? So if you can imagine, what's the difference? It's the size of the companies, okay? And all else equal, larger firms are more financially stable. Okay, it's just how it is, right? Larger firms are more financially stable, all else equal, on average, and so this would be like a size premium for small stocks. You know, size premium. Investors don't like risky stocks; they want financially stable stocks. So if they invest in these smaller stocks, they demand a greater premium, and that's, let me see, that's what explains this 2.2% difference in annual return. Okay, that will be the size premium. Okay. Yeah, so this table basically confirms what we've studied so far, that investors are risk averse. With more risk, they consistently get greater return. Okay, and that's because people don't like risk, and just markets are pretty smart. That's why we say markets are pretty efficient. Okay, markets behave in a way that's consistent with theory. Okay. Okay. Yeah. So value. This is another figure from this other textbook. I should have the citation up. I'll put it in the comments or something. So we have the value of $100 invested in various assets. Okay. So this again is based on historical data, actual data. So the idea here is we have all the data from before, right? So we're looking at a 1925 to 2015 period, And the idea is if you put in $100 into small stocks, that's a portfolio of small stocks, S&P 500, world equity portfolio, corporate bond portfolio, US Treasury bills, and CPI is just a measure of inflation, so we'll just ignore that. But if you put $100 in there and just left it, probably you're reinvesting dividends, I'm assuming, this is what your balances will be after 90 years based on actual data. Okay, so this little graph tells you a lot. Okay, and as you can see, as we go down the column here, the things are becoming safer, right? Smaller stocks are most risky. Larger U.S. stocks are less risky. World portfolio is a little bit tricky. We'll ignore that for now. Okay, but corporate bonds are safer, and then government bonds are the safest, and CPI will ignore too. Okay, you see that if you put $100 and left it in there for 90 years, your balance would have been 4.6 million if you invested in smaller stocks. And S&P 500, you still got a good return, 480k, and bonds, very small. I mean, it's still increased by 2,300%, but still. And treasury bills, basically not much, and so on. Okay. Yeah. And another thing, if you pay attention to the lines, the red line, the small stock portfolio, is way more volatile, right? When things crashed, those ones crash harder, okay? Whereas if you look at these, this yellow line, for example, the corporate bond line, it's relatively flat. What color should I use? You see it, right? So I'm gonna, this yellow line, drawing on top of this yellow line, it doesn't fluctuate that much. Whereas this small stock portfolio goes from here to here. It's like really volatile. Okay, so yeah, it's again, it's a trade-off between volatility and the expected return. But here's the key. Okay, the conclusion here. There's another conclusion after this, but here, if you're investing for a long time, 90 years, we probably won't be able to invest for 90 years, but at least most of us 30, 40, hopefully 50 years, right? So if you're investing for a long time, it makes sense to put a lot of your money into something that's more risky. Okay, it's gotta be a good risky portfolio, not some garbage risky stock. Okay, but something risky, so you can withstand the volatility during these years, because we don't know when a crash will happen. Okay, no one can really time the crash. It's really hard, right? So if you're investing for a long period, you should invest in something risky, and that applies to you guys because you guys are young. So you should start investing early and keep putting in money into something risky. Okay, so that's why it makes sense to set aside a portion of your earnings. I don't know how much, but keep putting it into your account, into usually equities, maybe some cryptocurrency, so you can withstand this volatility and still put in money. Okay, and your balance will grow by the time you retire, so you have some you're financially secure when you really need the money the most. Okay. So this we'll stop after this slide. Okay, so this slide shows you what I just mentioned, basically. Okay, so the way to read this slide is we have 4 panels, right? So the same types of securities: small stocks, S&P, corporate bonds, and government bond. Okay, risky to safe. Okay, safe. And here's the key. In panel A, you're gonna invest for only 1 year. So your investment duration is really short. Panel B, 5 years. C, 10 years. D, 20 years. Okay? And the x-axis shows you when you enter into the market. So you have $100, and if you enter into the market in 1927, for example, then if you hold small stocks, you lose about more than half of your money. Okay? But if you invested in corporate bonds, I don't know if anyone's colorblind here, the yellow line doesn't fluctuate as much. Okay. If you invested in the small stock portfolio in maybe 1932, then you would have almost tripled your money after 1 year. Okay. So the conclusion here is, looking at this, if you are a short-term investor, if your investment duration is short, you're basically gambling, and your timing matters a lot, as you can see. Okay, and short-term for risky securities, to be precise. Okay, but let's go to value after 20 years. So if you're a long-term investor, you might enter into the market at the worst time period, right before the crash. So here, same entrance point right here, right? But after 20 years, the stock will still recover, the portfolio will recover, and investing in something more risky, you see the red line is almost always above all the other lines, and the blue line is almost always above the yellow and green line, and so on. Okay, it just means the timing might be unfortunate, but if you invested in something risky, after many years things cancel out, and you'll have a greater balance if you put your money in something that's more risky. Okay, so you want to compare. Makes sense, right? Hopefully. In this panel, sometimes the red line is below all the other lines, sometimes it's above all the other lines. It's all volatile, messy. You're gambling, okay? Gambling. But here in panel D, the timing still matters, but it doesn't matter as much as shorter term, okay? The red line will almost always be above the blue line, except for this period, and so on, okay? Okay, we'll stop here.